In January 2026, the US saw layoffs at levels we haven't seen since the Great Recession. Over 108,000 people in a single month. But this story isn't just about job losses. It's about what happens next. So, today we're breaking this into three parts. First, the layoffs and why they are flashing red. Second, how Europeans react. And third, why America's situation looks very different from Canada and Europe. Let's talk about what the numbers really telling us. January 2026, 108,000 Americans lost their jobs. That's the worst January since 2009. Not a blip, not seasonal, it's the start. Job cut announcements more than double compared to last year. And hiring plans? Almost non-existent. This wasn't just the tech industry either. This was logistics, healthcare, corporate operations. Deep UPS cuts and Amazon cut again. The Canadian boycott works. And healthcare? Tens of thousands of jobs lost in just 1 month. When companies do this, they are not guessing. They don't have a choice. Not a choice but bracing for weaker demands, for consumers pulling back, for tougher months ahead. And here's the thing most people miss. Employment drives spending. Spending drives the US economy. When layoffs spike, demand flattens. Fewer paychecks, fewer purchases, more cuts. This is how recession starts. Quietly, and then all at once. Now, here's where it gets interesting. European investors didn't wait for press releases. They didn't wait for official recession labels either. They saw what's going on in the US. They saw the layoffs. And they moved. In finance, employment is a leading indicator, not a lagging one. When layoffs hit Great Recession territory, while the orange conman talks about economic miracles, investors notice. They notice the disconnect. Every European leader knows Trump is an idiot, a serial bankruptcy, 34 times convicted fraudster, a laughing stock, and Europe acts accordingly. Capital starts pulling back from the US as investment reviews got stickier. American assets starts getting treated as high risk, not because of ideology, because of math. High layoffs, weak hiring, ridiculous tariffs, and political volatility. From an investor's point of view, that's systemic risk. And yes, because of that, Europe has been quietly reducing exposure to the US markets. Those job numbers didn't cause that trend. They just confirmed it. Big money doesn't wait to be last out of the door. Now let's talk comparison. Canada has layoffs too. Europe has layoffs too. Tech has been brutal everywhere. But here's the difference. Capital isn't fleeing Canada. European money isn't abandoning Europe. Why? Because context matters. In the US, layoffs are happening while the dollar weakens continuously. Bond yield jumps, and Trump's trade policies are nothing but idiotic. That combination shares long-term investors away. Add in leadership messages that says everything is perfect while facts prove the opposite, then confidence erodes fast. Even political insiders in the US have admitted there is a gap between what Americans are told and what they are living. That gap creates instability, and instability drives capital away. In Canada and Europe, that narrative is less enthusiastic, but closer to reality. And markets can handle bad news. They can't handle denial. That's, my friend, is the difference. To make this clear, Europe isn't abandoning America out of spite. They are responding to signals. Layoffs at recession levels, hiring drying up, and a growing gap between data and messaging. History tells us how this plays out. Either the story changes to match reality, or the worsened reality flies in everyone's face, and investors are not waiting to find out. If you want clear-eyed analysis without a spin, share this video, talk about it, and stay curious. And please don't forget to share your thoughts in the comments below. Also click the like button and subscribe to the channel. When it comes to politics, numbers always tell the truth, long before the headlines do. Thanks for watching, and till next time, I'm Wilfried Lemkuller with Europe Curious.